The Federal Reserve, FDIC, and OCC recently released a 1,241-page Notice of Proposed Rulemaking. This document initiates an extensive overhaul of U.S. bank capital requirements. The proposal targets the largest financial institutions in the country. It applies to Category I and II banking organizations, as well as any bank with over $5 billion in trading activity. Currently, these institutions manage a dual-track regulatory requirement. To determine how much capital they must hold against potential losses, they calculate their risk-based capital metrics using two independent methodologies. First, they use the standardized approach, which applies a universal fixed set of risk weights to all assets. Then they run the math again using the advanced approaches. This framework allows banks to use their own proprietary internal models to estimate extreme tail risks and determine their capital buffers. This diagram illustrates the outcome of that dual system. Two separate banks can hold the exact same portfolio of loans, derivatives, and assets. Because their internal models rely on subjective, bank-specific assumptions, processing that identical portfolio through their respective advanced approaches can output vastly different required capital reserves. The agencies are attempting to eliminate this mathematical discrepancy. The proposal aims to replace the privacy of internal modeling with a single, standardized reality. The architects of this overhaul are the primary U.S. federal banking supervisors. Under the proposed rule, the use of internal models to calculate risk-based capital requirements for credit risk and operational risk is completely eliminated. The advanced approaches framework is stripped out entirely. In its place, the agencies are introducing the expanded risk-based approach. This is a comprehensive, standardized framework that varies capital requirements according to specific, verifiable risk factors, like loan-to-value ratios. There is one critical exception to this rule. Banks are still permitted to use internal models to calculate their market risk capital requirements, though the framework governing those models is heavily revised. The distinction comes down to data density. Market risk is generated by trading activities, and trading creates a constant stream of price observations. This high-frequency data provides daily feedback, allowing regulators and risk managers to empirically verify the accuracy of the models through backtesting. Credit and operational risks lack that reliable daily feedback loop. Maintaining systemic stability requires discarding modeled precision in favor of actual, enforceable transparency. To understand why the advanced approaches failed to produce consistent capital requirements, we have to look at the exact data constraints cited by the agencies. This curve represents the probability distribution of economic downturn losses. The advanced approaches require banks to model for extreme tail risk events, specifically targeting the 99.9th percentile of potential operational losses. To find that extreme edge, banks have to estimate loss given default. Loss given default, or LGD, is the percentage of a total exposure that a bank expects to lose if an obligor defaults during a severe economic downturn. Calculating that accurately requires decades of historical data from actual economic crashes, data that simply does not exist in sufficient volume. Without concrete data, banks are forced to plug the void with highly subjective modeling assumptions. Risk managers must select the exact time window used to define the economic downturn. Because each bank chooses its own time windows and methodologies, the required capital output swings. This creates the divergence problem, where the regulatory capital a bank holds becomes disconnected from the actual objective risk of the underlying exposures. Eradicating this parameter uncertainty is the only reliable method to ensure large banks are capitalized consistently across the entire financial system. To achieve that consistency without sacrificing risk sensitivity, the expanded risk-based approach scales risk weights using highly granular objective criteria. For real estate exposures, the risk weights now scale based on two strict metrics. First, they look at whether repayment depends on the property's cash flows, like a rental property. Second, they measure the loan-to-value, or LTV, ratio. LTV is the amount of the loan divided by the appraised value of the property securing it. The framework applies a similar objective sorting system to counterparty risk. Exposures to other depository institutions, foreign banks, and credit unions are now rigidly classified into Grade A, Grade B, and Grade C categories. To achieve a Grade A classification, the counterparty must pass strict hurdles. The obligator must be officially rated as investment grade, and its publicly disclosed capital ratios must exceed minimum requirements to be considered well capitalized. This matrix shows how the objective inputs calculate a specific risk weight. If a Grade A counterparty meets high thresholds for its Common Equity Tier 1 ratio and its supplementary leverage ratio, the exposure earns a favorable 30% risk weight. The Common Equity Tier 1 ratio, or CET1, measures a bank's core equity capital against its total risk-weighted assets, while the supplementary leverage ratio, or SLR, measures Tier 1 capital against total leverage exposure, including off-balance sheet items. By tying the output to verifiable metrics like LTV and CET1 levels, a bank's capital requirements automatically adjust to the specific risk of its business activities, completely bypassing the black box. While the overarching goal is global regulatory consistency, U.S. regulators are explicitly deviating from the international standards drafted in Basel to protect domestic markets. One of the most significant deviations involves mortgage servicing assets, or MSAs. An MSA arises when a bank sells a mortgage to a third party, but retains the right and obligation to collect the monthly payments and manage the escrow in exchange for a fee. The current capital rule is highly punitive toward these assets. Large banks are forced to deduct the value of MSAs that exceed 10% of their capital directly from their Common Equity Tier 1 baseline. That strict threshold deduction disincentivizes banks from originating and servicing mortgages. Because the capital penalty is so high, banks sell off the servicing rights, pushing the systemic risk out of the heavily regulated banking sector and into non-bank financial intermediaries. The proposed rule reverses this dynamic. The CET1 threshold deduction for MSAs is completely eliminated, allowing banks to keep these assets in their core capital base. This block model demonstrates the counterbalance to that relief. While the MSA deduction block is reinserted into the top capital base, the assets carry high prepayment and liquidity risk. To offset that risk, the risk-weighted assets block at the bottom of the equation expands by applying a flat 250% risk weight to all MSAs. This specific regulatory pivot removes a significant hurdle to traditional bank lending while maintaining a localized capital buffer appropriate for the volatility of mortgage servicing. The expanded risk-based approach does not exist in a vacuum. It integrates directly into the broader, forward-looking U.S. regulatory ecosystem. A crucial piece of that ecosystem is the Stress Capital Buffer, or SCB. The SCB is an explicitly forward-looking capital requirement determined by the Federal Reserve's annual stress tests, which measure how a bank's balance sheet holds up under severe hypothetical macroeconomic crashes. Because the SCB already measures extreme tail risk and forces banks to pre-fund for economic disasters, maintaining overlapping internal models in the baseline capital calculation is redundant. Alongside eliminating redundancy, the proposal addresses the operational mechanics of the rule over time. The framework uses hard dollar thresholds to determine regulatory tiers, such as the $5 billion trading activity trigger that subjects a bank to the market risk framework. Static thresholds create a distinct structural problem. Over time, inflation causes passive regulatory creep. As nominal asset values rise, smaller, less complex banks eventually cross the dollar thresholds and become subject to costly rules designed exclusively for internationally active GSIBs. This diagram illustrates the mechanical solution. The proposal indexes these dollar-based regulatory thresholds to the Consumer Price Index for Urban Wage Earners and Clerical Workers, or CPIW. The CPIW is a primary measure of inflation calculated by the Bureau of Labor Statistics. Tying the thresholds to actual inflation preserves the intended application of the rules in real terms, preventing the framework from passively degrading over decades. This simulation represents the final calculus of the overhaul across the U.S. banking sector's balance sheet. When all the new risk weights, deductions, and models settle out, the system establishes a new equilibrium. The agencies project that, in aggregate, the proposal will increase Common Equity Tier 1 requirements for Category 1 and 2 holding companies by approximately 1.2%. That aggregate increase trades marginal capital efficiency for safety, soundness, and global competitive equity. This implementation shifts the regulatory focus from bank-led estimation to a single prescribed standard for the entire industry. By deploying standard, granular risk weights, regulators eradicate the divergence problem that allowed identical portfolios to masquerade as different risks. By killing the black box of internal models, the U.S. banking system establishes a highly sensitive, durable, and transparent architecture capable of surviving the next era of financial volatility.